People are getting nervous out there. There's a little bit of blood in the streets. Not a lot, just a little bit, because people are getting nervous watching some of their prized possessions dropping very quickly over the last few days. A lot of ARK investors have gotten a little bit of a haircut in the last few days. I called out a video on the potential risks with ARK recently on YouTube, so you can click on that if you're interested. I'll put a link in the description of this video to that. But the market's down just a little bit, folks. Like, it's too early to start being like, oh my gosh, it's a crash. Like, hey, wake me up when the market's down 30, 40, 50% plus. That's a crash. When you had the like, oh my gosh, Black Friday, market's down 10% a day, now you're starting to get into interesting territory. Down a couple percent, meh. I've seen worse. So recognize where we're at. Now, first, quick break. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel. I'm usually trying to find exceptional companies and unrivaled investments, trying to find potential multi-baggers, types of companies that go up hundreds or thousands of percent. In this case, I am doing this video on the stock market and general market commentary because there's a little bit of jitters. There's people a little nervous on what's going on. The two main questions I keep hearing over and over again is how far can it potentially drop? And next is how can you potentially profit from a crash or at least just not lose a lot. So let me start with how far can it drop? And this is actually where I think I can have some valuable insights for YouTube viewers, which is the answer is, and I'm sorry that it's not going to be precise. I'm not going to be able to say the market can drop exactly 55%. The answer is that it depends. And the reason why is take a hard look at this guy. I bet most folks have never even seen this picture before, or have no idea who he is. He is Andrew Mellon. He used to be Treasury Secretary of the United States, and he oversaw the policies that ultimately made the Great Depression made it the depression that was terrible, where the stock market ultimately dropped about 90%. So how did you have a market condition? Like, how can you blame one guy that makes the condition that much worse? And like, let me call out a few of the things that he did that made it worse. Like, one is he was like, as the market was dropping, he's like, you know what, speculators, they deserved it. Those words, they deserved it. Like, next when the market was dropping, he loved collecting art. So he's like, this is great. Some of these fellow art collectors, they own a lot of stocks. They're taking a haircut. They're going to be forced sellers of their art. So he's like, yep, I'm going to get my art on the cheap. So he was all for it. He was on vacation when a banking crisis started happening. And he's like, whoopsie, just happened to be on vacation. The financial crisis, in his words, was something to be weathered. Just deal with it. Suck it up, buttercup. And so, when you have someone like this that was running the Treasury Secretary, it's a key point we're thinking about. I mean, one should also recognize how far the system's evolved, as the Federal Reserve at the time actually raised rates. This is the early 1930s in order to stem the flow of gold going from out of the United States. Raising the rates made it even tougher for economic conditions, causing the market to drop further. And he also, Andrew Mellon, he owned some of the prominent banks. And so when a major Pittsburgh bank failed, he was like, yeah, that's fine because more depositors are going to be sending their funds to my bank. So the reason why I share this is that when I say the market can drop, it depends. It depends on what policymakers are going to do about it. If you see, let's say, interest rates start spiking higher and policymakers are like, yeah, whatever, let's just increase the stimulus and, raise the deficits, then you could start creating, problematic feedback cycles. If you have, policymakers that say, hey, let's start, raising taxes for corporations a lot. Yeah, that could also impact the valuation of companies. That would also hit stocks. So a lot depends on what did the policymakers do. That said, from a high level perspective, one should note that a large percentage of the, let's say major U.S. returns, major index returns over the last few years have been driven by valuation expansion versus underlying fundamentals. And that is a big risk because longer term, over a multi-decade period, valuations tend to get compressed. Gains from valuation tend to get compressed. Your gains from valuation tend to get wiped out, whereas it's your returns from the fundamentals. What is the sales? What are the earnings that actually drive your returns over a 50-year period, over a multi-decade period? So when you see a period like we've had for the better part of this last decade, where valuation gains were a big contributor, especially for a lot of one-off stocks. There were a lot of stocks where it's like, hey, this is a dividend substitute. This is an income substitute. Why not buy it? That valuation expansion doesn't always work. And that is a key risk for investors to consider. So could it drop a lot, a heck of a lot? I absolutely do think so. Is now the time that it's going to happen? That's a different question. I'm not going to get into like, hey, when is it officially going to happen? That's a separate answer, and I actually do have a little bit more detail on that, but we'll get into that in a second. So first of all, we've now addressed like how far can it drop, which is like, yeah, it depends on what do policymakers do, and is it enough? Is it enough to address the going concern narrative? And the narrative in the great financial crisis was, hey, can we save the financial system from the subprime debt that is creating this big hole in all these in the balance sheet of all these major companies. In the dot-com bubble is, hey, there's a lot of stocks, effectively stock market inventory, that trades at ridiculous valuations, and that they're going bankrupt because there's all this cash burn and no profitability and actually no revenue. So hey, there's this wide gap between reasonable valuation and where it trades. So you need to sort of understand these aspects when you're thinking about how far can it drop and looking at it on a company by company basis. That's the key theme. You need to go company by company perspective. So then the next question is, how can you profit from a crash, or at the very least not lose a lot? So one, I would argue, like, you need to figure out what game you're playing. Because if you're playing the game where it's like, hey, I'm playing the chase the momentum game, and you're chasing stock price momentum, and if you have a long, if you are able to track long-term data that suggests chasing price momentum works, and you can point to all these other investors that it have worked for over a multi-cycle perspective, then I'd say more power to you. But don't change lanes, or don't change the game when it starts going against you. So in other words, if you're playing a momentum game and all of a sudden stock prices aren't still going up, don't all of a sudden have thesis drift where you're like, oh yeah, now I'm a deep value investor because I was playing this stock and whoop, now it's down 30% and now it's value. That's where you start really losing your money, because you probably don't actually know what's the reasonable value for the company. And that's why my personal focus, I'm not trying to chase gains. What I'm trying to do is focus on the fundamentals. That's every company I look at, I put out a range. I'm focused on the fundamentals, what's going to drive this business longer term, and put out a wide range of valuation. Now, with a wide range of valuation, that means a wide range of assumptions. What's the growth? What are the margins? What's the multiple? You need to have a wide range on each of those things. If you're just picking a pie in the sky number, oh, I think this company should trade at 7 times sales, that is a recipe for disaster, because you're not including all these different components, different interest rate environment, different tax environment, different margin environment. These things all impact what the return looks like. So just saying, oh, 7 times sales, that's no way to value stocks. You need to do a more detailed analysis. And that's why in each company I look at, I provide for YouTube subscribers a valuation range. Now look, you can disagree with me. I'm totally open to that. And I provide it in the links, so that way you can play around with the assumptions yourself. Like, hey, here's the growth potential, here's the margin potential, here's the multiple. You change around it, to reflect what you want. But when you see, and I often get comments like, now Daniel's old school, like, man, he doesn't understand how stocks are priced these days. Like, fundamentals don't matter. Folks, wake up. Like, you can play a game like that. The fundamentals don't matter, but you're going to be playing the same game that the folks in the dot-com bubble were playing, where it's like, hey, it doesn't matter. It's just eyeballs relative to the site. And one day people wake up and you've lost 90%. And so that's, like, playing a game that's not based on some sort of logic, whether or not it's price momentum or fundamentals. I just say stick to whatever game you're going to play. If you're playing price momentum and it's no longer price momentum, recognize that and adapt. And so if it's, stock prices are no longer going up, focus on the stocks that are still going up and own those, transfer out of it. So that's like recognize what game you're playing. If you're playing it, I don't play that momentum game. I focus on fundamentals, and I try to do a wide range of valuations such that it creates a win, ideally a win-win setup where even if it doesn't work out, even if the growth rates don't match what I expect over a 5-year period, you know what? I still don't lose that much. So like if it works out, great. If it exceeds my assumptions, fantastic. I make a lot, and if it doesn't, I don't lose that much. So that's why I try to find these asymmetric setups. Unrivaled Investing Journey subscribers know about like each of my calls. It's like, hey, I think this is asymmetric risk reward. At the end of the day, if you're just a speculator buying stuff because other people have done it, I'd want to rethink my life choices, my investment choices for sure. Because like, look, you don't know how that will play out. If you look at the world's wealthiest people, it's because they own equity interests in companies that compound longer term. If you're just buying something because someone on Reddit posted about it, I'd want to rethink about it. I'd want to understand what's the real thesis that's driving about it versus this is going to the moon. So what's another way to profit from a potential market crash, or at least prepare yourself for it? The other aspect is to have cash ready to deploy. That way you can deploy it in bargains that are just truly mouth-watering. The reality is that every market bottom, there are company prices that just don't make any sense. You'll be able to find net nets, and net nets are companies that trade below liquidation value. When you start seeing a lot of companies like that, there's blood in the streets and valuations are starting to get a little kooky. Right now, I'm not seeing any net nets, and that's honestly not what I'm focused on. I'm focusing on the potential multi-baggers, longer term, good growth stories. But it's an example of what you see out there. And then the last component is hedging, which is effectively how do you profit from the market going down? You hedge or short sell or buy some options that will profit as these different prices go down. And that, and that's sort of where I'm going to leave off here, is that's part of some of the exclusive content that I posted, of like, hey, how do you hedge? Where do I think we are in the market cycle? Or do I think we're closer to the peak versus the bottom? How do valuations look? What's the narrative that's driving the market? Because at the end of the day, every market cycle has a narrative. At the end of the day, I try to post, if you go to unrivaledinvesting.com journey, I have all this type of exclusive content. Most of it's focused on finding at least one potential multi-bagger each month, because that's sort of my life view is, hey, if you just find one potential multi-bagger, that can really help you out with your own personal finance journey. And so each month I'm trying to find these types of companies that I think can go up hundreds or thousands % over time. And you can also, going to unrivaledinvesting.com, you can see my personal portfolio, the full detail of like how I've allocated, and I update you with percentage allocations. But I also have stock market commentary like I have here on like how do I think about hedging, when do I do it, where do I think we are in the market cycle. And then I also have exclusive follow-ups on some of the companies that I do breakdowns here on YouTube, where it's like, hey, I'm breaking down this company in terms of what their value proposition is, but let's do an additional deep dive for Unrivaled Investing Journey subscribers. So that's part of the secret or special exclusive sauce that I bring to subs. But I hope this video has been helpful in terms of thinking about what to do in the market. Don't lose yourself. Like if the market starts to crash, don't panic. Stick to playing your game. Recognize what game you're playing. If you've been playing a foolish game, recognize that, and I'd argue try to go to a more rational game sooner rather than later. How far can it drop? It depends on the people. It depends on who's running the show. What are the dynamics involved? What's the ongoing narrative that's starting to shape the market? Those are all the types of things that you'd want to think about. And I hope this video has been helpful for you. Thanks so much for watching.